Welcome to Investors Guide. Thank you so much for tuning in. You're watching ET Now. I'm Faye D'Souza. The idea with this show is to help you with all of your investment decisions, to help you stay on top of your entire finances and to make you rich over the long term. There's an email ID at the bottom of your screen where you know you can reach us if you have any questions, but you can reach out to me personally on Twitter as well. On the show this week, we'll help a young investor save enough for his sister's wedding over the next 6 years. In our product this week, we look at the Sundaram Taxsaver, and we'll tell you how you should take advantage of Section 80CCG if you're a first-time investor. Let me bring in Narendra Kumar, the CEO of Value Research. Narendra, thank you for joining us this week. We're entered now the month of December, and in spite of repeated reminders that we should start doing our tax-saving work in April, I'm sure there are still some viewers who haven't got it started yet. December is normally a good time for the late joiners to also get in on it. The question obviously is, if I'm investing in equity for the first time, should I use the Rajiv Gandhi Equity Savings Scheme? Should I be using the NPS? Should I be using equity-linked saving schemes? What is the best option to get tax saving and to invest in equity?
Definitely, every investor should try and avail the 80C, entitlement available, which is a maximum of 1.5 lakh rupee. And there I feel that, investors should make a very clear choice. If you are an extremely conservative investor, can't take any chances, and, you are likely to retire in 5 years, and the money that you are saving is very important, then you don't have a choice. But, looking at either your provident fund deduction itself will take care of it, or you have it in a national savings certificate or a 5-year term deposit. But I think, the tax saving fund is the finest choice available, and nobody should look at anywhere in between, because there are many other options in between the ULIPs and the endowment policies and other things which one should ignore. Of course, you also have some entitlement towards on account of your deductible expenses. For example, the tuition fee for 2 children is also an entitlement that can also be declared, and you can take that concession. If you have any time of 5 years and more, then you should consider ELSS. And I think on this time frame, it turns out to be the most productive, most rewarding investment for 2 reasons. One is that it's the only thing which is all equity. And the other is that even the income from the ELSS, which comes to you in the form of appreciation, is tax-free because it is an equity investment. When you make your investment in NSC or the tax-saving deposit, the income that you derive in the form of interest is taxable.
Okay, so what I'm going to do is I'm going to put up on the screen the equity-linked saving schemes or the tax-saving mutual funds that we normally recommend on the show. The first list are of aggressive tax savers, so if you're a younger person with a longer time horizon, it will suit you. The second list is for conservative tax-saving funds. So if you're in your 40s, you don't want to take that kind of risk, this is a slightly more conservative list that you can use. Narendra, the question will now be what sort of SIP to start, because if I'm looking for tax saving for this year, then I have 3 months, so that's a 3-month SIP. But ideally, we should have people choose longer SIP systems so that they're not in the same boat again next year saying, what do I do with my tax saving? What's the best way to solve that problem?
I would urge, investors to look at, choose one fund, commit for 3 years, if not for 10 years, simply because, committing to a fund and any equity investment, you have to do a review periodically. And also I feel that, a bad fund it's very hard to predict that which would be the best performing fund for your investment over the next 10 years. So one is anyway doing a measured guess with one's choice.
All right, so make a commitment to a 3-year SIP in your tax saving fund. That list is running on your screen one more time. If you have any questions, you can get back in touch with us. Email ID is on your screen as well. So is my Twitter handle. Well, let's move on to our portfolio question. This first question comes in from a 29-year-old. PIYUSH writes in from Bangalore, Narendra. He wants to build a retirement corpus, he tells us, of 1.5 crore rupees over the next 10 years, which means that he's looking at retiring at 40 or 39. He also wants to buy land worth 15 lakh rupees over the next 2 years and have a corpus of 20 lakh rupees in his hand in the next 6 years for his sister's wedding. He sent us his financial details. He has an income of a little over 1 lakh rupees. He has an EPF deduction. He has added PPF contribution on top of that. Pure gold investments, he says, for his sister. He's also got 12,000 rupees going into a recurring deposit. And he tells us he has 15 lakh rupees in pre-IPO shares. Now, There's some property in Lucknow for which he's paying as well. He has some insurance plans that he's holding. There's a term insurance and a life insurance policy, and 21,000 rupees going into mutual funds. So there's a lot going on in his portfolio. I would personally like to streamline it a little bit because it does seem like he's contributing to a lot of things, but not really looking at it all together holistically to see where the money is going. If you were to sort of shuffle his portfolio around, Narendra, what changes would you make?
No, he's not disorganized. You know, he's fairly organized, and I just think that he should be clear about his goals. And you know, he has three clear goals. One is the early retirement, and then the sister's wedding, which is the first one is non-negotiable. He needs very clear amount of money. So he should stop his recurring deposit the moment he thinks that he has enough in terms of emergency money as well as the money which is needed in the foreseeable future, which is 3 years time frame. And 3 years time frame, you should only have fixed income, so that recurring deposit takes care of that. Beyond that, I don't think he should be spreading his investment elsewhere. Here he is well covered with a term plan as well. So he should just realign his portfolio to 3-4 funds. Our aggressive growth portfolio for a 10-year term can get him the desired direction as well as the discipline.
Well, if we take a look at the funds in his portfolio that he has right now, Narendra, he has the Tata Balanced, SBI Magnum, Mid Cap, Mid-A Asset, India Opportunities, iPro Focus Blue Chip, Franklin High Growth Companies. They all seem like good choices, except for Tata Balanced. I'm not sure why he has that in his portfolio. Although it's a great balanced fund, it might not suit his needs.
If he's in the growth option, if he's not actually deriving dividend out of it, because most investors are fond of Tata Balance for its consistent dividend payout, which I find quite unusual. But that's fine. A lot of investors have gotten used to it, and they like it primarily for that reason, which may not be the best reason to invest in a fund. But still, yeah, I would say that he should look at it as a conservative equity fund, almost like a large cap fund with 20-25% into fixed income. So going by his selection, I think it's an excellent portfolio, and he should carry on with this and increase his investment amount as and when he's able to increase his as his income rises.
Carry on with your portfolio. Remember to increase your investment amount as and when your income rises, and of course keep a close eye on inflation and the impact it will have on your retirement goal, which is 1.5 crore rupees in the next 10 years. Welcome back to watching Investors Guide on ET Now. Thank you for staying with us. Let's take a look at the product review for this week. We're looking at the Sundaram Taxsaver Fund. It's a good time to look at a tax saver fund, considering you should be looking after your taxes at this point. Avan is here to give us a quick introduction. Avan.
Thanks, Faye. This week, we take a look at a tax-saving mutual fund, the Sundaram Taxsaver. With over 1,180 crore rupees as assets under management, this fund has marginally performed better than its peers in a rising market over the long term. Let's take a look at the fund's performance over the last 5 years. Now, you'll see that the fund has underperformed its benchmark and category in the recent years as well. In fact, even when the fund performed marginally better than its benchmark in 2014, its performance was well below its category. The fund's performance over the long term has not been very promising either, thereby lagging behind its peers in a rising market. Is it time then for you to exit this fund and invest in other tax savers? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that introduction. 2 stars, Narendra, on value research for this fund, but it still has an AUM of about 1,100 crore rupees. Performance has not been great. It's not part of the list that we recommend as tax savers. It hasn't been for a while. For those of our viewers who are not locked in right now, is it time to call it quits?
Yes, simply because there are superior options and there are superior equity funds. If you are out of the lock-in, you can park your money elsewhere to make it more productive. And looking at the tax-saving options, this fund, if you look at the dissection of the rating, it's below average return relative to other funds and above average risk, more volatile. And the way tax-saving funds, if we look at the top 10, the way, in fact, it's quite an irony that here is a fund which has beaten its benchmark, but it does not qualify for many years. except for 2013. But for many years, despite that, it does not qualify as a choice among tax-saving funds.
Well, Narendra, I'm going to ask you this question. I want to know about the entire basket of Sundaram equity funds. There used to be a time where it was mentioned far more often on this show. They don't seem to be as much in favor right now as they were maybe 4 or 5 years ago. What is your review right now of the fund management in that entire portfolio?
This fund company actually has some very promising, its mid-cap fund is among the most promising. Except for that, it has actually not emerged as a mainstream, equity fund house, despite having reasonable money in the equity fund, in its equity fund. So, looking at the series of micro-cap funds which it has launched, and its largest fund happens to be the mid-cap fund among equity universe. So that is a promising part. Except for that, I think this fund company does not qualify with many of its equity funds.
All right, and Narendra, for those of our viewers who are going to at this point action the sell call on this fund, if they are out of their lock-in for the tax saver, would you recommend they use our recommended list of tax savers and move their money into maybe one of those?
Yes, I would say that there are superior options, and if you are out of your if you are out of your lock-in period, then you have the whole equity universe to choose from.
All right, so if you're out of the lock-in period, the entire equity universe to choose from. So I'm going to do two things for you. On your screen, I'm going to put up the equity multi-cap funds that we recommend on the show. And also, if you want the tax saving, then there are equity tax saver funds on your screen as well. Finally, Narendra, for Investors Guide for our viewers, where would you rate this fund on a scale of 1 to 5?
Very much at 2 stars, where it gets slotted as on the risk-adjusted scale.
2 stars for the Sundaram Taxsaver fund on Investors Guide. Narendra giving it a sell call. We don't hear sell calls very often on this show, which means that it might be time to take your money out, provided you finished your 3-year lock-in. Let's move on to our hold or sell segment. 32-year-old Pramod Murthy has written in Narendra. He wants to build a corpus of 6 to 8 crore rupees for his children's education and his own retirement over the next 20 years. So he has 20 years, which is a nice, large, meaty time horizon. So there's enough time on his list to sort of, make some smart, maybe aggressive investments. The first 2 funds on his list, HDFC Top 200 and HDFC Equity. Would you recommend he holds on to both of them, or a 20-year horizon?
For a 20-year horizon, I would say that, of course, both these funds are struggling for a while. And the fund manager has given a very elaborate explanation to us that why one should hold, why his funds are promising, or they will do well over time. And he has his past to demonstrate. But I think the dynamics has changed a bit. But still, I would like him to, concentrate, consolidate his money in HDFC Equity, which has greater flexibility, and ensure that, his total amount in this fund for over the next 20 years does not exceed 25%.
He also has the ICICI Prudential Focus Blue Chip, Narendra. Continue that investment as well?
ICICI Prudential Focus Blue Chip has emerged as a very impressive large cap fund. And but I would say that investing for next 20 years, one should have funds which have which are reasonably flexible. This fund, by its design, will remain a large cap fund. The reason why I was telling him to consolidate his money from HDFC Top 200 to HDFC Equity is that HDFC Equity can invest across the market, universe. Likewise, this fund will also be focused on large caps only. So, he should consider the other funds of, he can switch his money from here to the dynamic equity fund or the, value discovery fund. They will have greater flexibility. And in 20 years' time, the difference will be visible.
He also has IDFC Equity, Premier Equity, Narendra, and HDFC Mid-Cap Opportunities. Continue both of those investments as well?
Yes, continue with both the investment as well. Though IDFC Premier Equity has changed, the fund manager is gone who built or he incubated the whole track record. And I'm watchful that how it's doing over time. But yes, these two are great funds, have been great funds in recent years. One should continue.
He has some lump sum investments that he made last year, from what I understand. Unfortunately, one of them, 1 lakh rupees, has gone into what he calls Canara Robeco. He hasn't told us the specific fund. The Starter Balanced and Reliance Taxsaver. Reliance Taxsaver, he won't have a choice right now because he's locked in. What would you recommend he does with the other two?
The other two, I really don't know which Canara Robeco, but the Canara Robeco has 2 equity funds which are quite promising. It depends. But I would urge him to, generally, abstain from, resist your temptation to make lump sum investment, because that can cause a degree of anxiety which will derail your investment plan. Whenever you have lump sum to invest, increase your SIP amount. That way you will be able to average your investment, and you will, because right now the possibility of investing a lump sum amount of 1 lakh rupee and that goes down to 80,000 rupee in between, it will get registered in your mind, and you will not be very happy, or you will not be happy sustaining, enforcing your plan. So don't do that. And Reliance Taxsaver has turned out to be a great small cap tax saving fund. It's part of our recommendations too. So carry on with that. But take a these I don't know which Canara Robeco fund, and Tata Balance turns out to be a good conservative equity fund. May not be the best suited fund for a 20-year investment time frame.
All right, so there you have it. That's the advice you're getting right now. Remember, if you would like us to take a look at your portfolio, write to us on the email ID that's at the bottom of your screen. Then a quick question before I let you go. Rohit Singh has written in. He has a time horizon of 5 to 10 years. He says he's been investing 10,000 rupees each in the funds that he sent us a list of: HDFC Equity, Franklin India, higher growth companies, and iPru Blue Chip Equity. Along that, he also has an HDFC Life Balanced policy with a lock-in of 5 years. Now, he tells us he's adequately insured by his company, so he has health insurance. He just wants to know if you believe he's on the right track with his portfolio so far.
Yes, 5 to 10 years time frame, he has chosen good funds. As I was saying earlier, that a large cap fund may not be the finest choice for a 10-year time frame. So he should consider ICICI Prudential Blue Chip Fund being substituted, and definitely he should work on a plan that the moment he's out of the lock-in with his ULIP plan, he should withdraw his money.
All right, so keep a close eye on that ULIP, and make sure that you can withdraw your money once you're done with that lock-in. And keep a close eye on the returns that the ULIP is giving you vis-a-vis what you're getting from the mutual funds, and that should be self-explanatory as to why we tell you to consider withdrawing your money out of your ULIP. Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. This week, we're going to answer the questions you sent in on your asset allocation with Vishal Kapoor from Standard Chartered, who joins us again. Vishal, thank you so much. Such a pleasure to have you make time to spend time on Investors Guide. Our first question comes in from Jilajit Yadav. He's been investing 5,000 rupees every month in the ICICI Tax Saving Mutual Fund over the last 2 years. He has a time horizon of 15 to 20 years, and he wants to increase his investment now and add another 18,000 rupees. So he sent us a list of funds he shortlisted, Vishal. He has the DSP BlackRock Micro Cap, SBI Blue Chip, SBI Small and Mid Cap, and Reliance Pharma. He also wants to put some money in the ICICI Prudential Discovery Fund. He wants to know, is he on the right track with his asset allocation? I'm not very pleased with the Pharma Fund, but what would you recommend he does?
Firstly, I think you've got a good mix of funds. You've got, from what I can see, micro cap, you've got a thematic, you've got a blue chip fund, you've got a discovery fund. So you've got a good range of schemes. The only thing I would think about again would be the thematic fund, which is the Reliance Pharma. Of course, there are good reasons to believe that pharma as a sector may do well. But if you do believe that you will be able to monitor it continuously, then it may be okay to stay put with thematic funds in general. Otherwise, you're better off being in more diversified players if you don't think you can monitor it very closely and shift when you think that the pharma story is played out a bit. The other thing in terms of allocation, you should have done by now your risk profiling. That would be the basis for us to suggest whether the allocation is right or wrong. Just being in equity, of course, equity is a good long-term asset class, but you have to balance it out with other asset classes as well. And how much of which asset class you need will only be possible once we've done a full-fledged risk profiling.
Next question comes in from Aryan Agarwal. He wants to make use of the Section 80CCG under Rajiv Gandhi Equity Savings Scheme. He's a first-time investor and he has an annual income of 12 lakh rupees. He wants to know how he should go about opening an account and what mutual funds he should be looking at. Vishal, now first of all, I don't know if you would recommend that scheme, because I would much rather he uses equity-linked savings schemes or the NPS instead of the Rajiv Gandhi equity-linked savings scheme. What would you recommend he does?
It's meant for first-time equity investors, and the good news is that the tax benefit applies for mutual fund investors as well. So rather than get into a full-fledged demat account and a broking account and doing complex calculations about which stock, which demat account, which broking firm, etc., an easier way, if I may suggest, to start maybe to just stick with mutual funds for now. And again, an SIP route or a systematic route to invest may be a good way out for first-time investors. The couple of funds that I could recommend over there would be the Franklin Templeton Prima Plus as well as the Kotak Select Focus. Large cap funds to start with. Do an SIP or an STP into these. It's a very simple process to get invested, and you get the tax benefits there as well.
Last question on the show comes in from Carol D'Souza. It's always nice to hear from a woman investor. She tells us she wants to build a corpus of 2 crore rupees over 12 years. These are her details. She's putting some money into the VPF. 50,000 rupees a month, in my opinion, that's too high. She also has the PPF, which is putting 1.5 lakh rupees a year, which is basically all going into the same end. So the PF, PPF, VPF, all of it winds up in the same place. She sent us a list of her mutual funds. She has HDFC Top 200 and mid-cap and equity. That's again something she might want to consolidate. She has Franklin Smaller Companies, Franklin India Higher Growth. She wants to know if she's on the right track. Rishal, would you streamline it a little bit and make it slightly, more efficient?
Assuming that your money would compound between 12 to 15%, you would need to save roughly between 50 to 60,000 rupees per month for that objective to be met. So that's important for us to start with, to know how much you need to be saving. So you need to be saving about 50 to 60,000 rupees per month. Now the good news is that you're already doing that. So when we look at your portfolio, you've already got 50,000 rupees per month in a voluntary provident fund, so that takes care of the fixed income part of your investing, and you've got a selection of mutual funds that are taking care of the equity portion, again adding up to a significant amount. So at an aggregate level, you could look at a portfolio where you've got both fixed income and equity coming through funds as well as a VPF account, and the quantum definitely seems to be adequate as of now. The only refinement you could look at is that the amount under VPF does seem quite large. Now, given the fact that you do have a long-term time horizon, 10 to 12 years, you could look at actually increasing the equity mutual fund component through either an addition to the existing funds that you have, or maybe add a new fund, a few more funds. So I would look at a slightly more aggressive equity mutual fund component in your savings, and I think you're well on your way to achieving that target that you've set for yourself.
All right, Vishal, thank you so much for spending time with us this week and answering our questions. Remember, if you have a question for Vishal Kapoor, write to us on the email ID that's at the bottom of your screen. You can also reach me on Twitter. It's always a pleasure to hear from you. So any feedback you have as well on the show, feel free to get in touch with us. So before we wrap up, something I must share with you. We have a brand new channel we've launched within the Times network. It's called Magic Bricks Now. It brings you all of the information and the advice you need when it comes to buying property. India's first 24/7 property channel. Tune into Magic Bricks Now. Get in touch with us if you have questions about buying property. That's what we're here for. Thanks for watching.